Welcome back to another weekly market and financial update. Short week this week with the Thanksgiving holiday, and I hope everyone has their plans lined up and they get to spend time with their family, friends, and loved ones. With that in mind, let's dive right in. So, really, the main conversation around this week are two things, and it's the market being at an all time high. Right now, consumer and investor sentiment is also at an all time high, which is really what's leading the markets to be pushing in an upward direction. We have seen a tremendous run of this bull market over the last couple of years, and there's really no signs of this bull market ending anytime soon. It certainly might have some bumps here and there. We might see some market declines, especially as we transition into the new year and what the Fed will ultimately do with interest rates. But there really is no indication that the bull market will come to an end. And I think the Fed is going to ultimately have some great news on their end of being able to deliver the soft landing that they've been talking about. In my opinion, I think we're already pretty much there. We just have to see what's going to happen with eventually the rate cuts as we approach 2025. The Fed has indicated that they do want to slow down their rate cut schedule a little bit, which is really not much of a surprise to me at all, just because of the fact that most people, myself included, thought the Fed was going to lower rates by 25 basis points, and they were pretty aggressive and lowered rates by 50 basis points. So I think the Fed realized they probably were a little bit overzealous. I know there is pressure for them to reduce rates as quickly as possible, but there really is no rush at the end of the day. It's better to take your time with this. And I think the Fed is realizing that taking your time is ultimately going to have a better long lasting effect than rushing and doing more significant rate cuts versus slow and steady rate cuts. So, with that in mind, I think that's really the only area we'll see some volatility coming from toward the end of the year. But other than that, the market is looking really, really well. Now, on the other front, the news has been talking a lot about the Donald Trump tariffs. That's really what he has talked a lot about in his campaign about implementing tariffs, tariffs, tariffs. And it's coming in with mixed reviews from different media sources. Now, some media outlets are going to say this is really bad. Other media outlets are going to say this is fine. And let's break it down a little bit because I think there's definitely still some lingering questions from a lot of folks out there, especially when we don't understand the implications of tariffs in great detail. So, tariffs, all they are is just an additional tax on goods that are imported into the United States. So, any country outside of the United States or any business that is doing business outside of the United States that wants to bring their goods and services back into the US will pay a tax. Now, this is a common occurrence across all countries across the entire globe, but we can control or limit or increase the amount of tax that we impose on any business or country that wants to bring goods or services into the United States. And Donald Trump has said throughout my campaign, I want to increase tariffs, and he appears, at least for now, that he is going to deliver on that promise when he takes office next year. So we'll ultimately see what happens. Some folks are saying this is more of a bark than a bite, where other people are saying it's a bark and then a bite. So we'll see what happens. But if tariffs do come into play, I think there's some important considerations that we should be aware of, especially when making investment decisions around our portfolios. So tariffs typically will hurt businesses overseas, right? Because they will have an additional cost to bring their goods and services back into the United States, where a bulk of their market share possibly could be. So with that in mind, this leads to companies that are doing business overseas. Their stock price might not be as strong as another company who's mostly located within the US or completely located within the US. They're not going to be subject to those import taxes or tariffs, right? So this can give us some good insight of how to make good investment decisions, especially as we transition into the new year. And so all that means is that we just want to be mindful of companies that have an international presence. Are they bringing lots of goods and services into the US? And if they are, then maybe this is an opportunistic time to relocate some of our dollars from international firms to domestic firms. Or we might say that any dollars that are currently sitting on the sidelines, especially as cash yields start to come down, we might say, you know what, we're no longer happy with our savings yields or CD yields or money market yields. They were at 5% a few months back. Now a lot of them are hovering around 4.25%. And as those rates continue to fall, we might say, well, what do we do now? I'm really not okay with getting a 3% rate of return on my cash. Where should I put my money? And this leads to maybe looking at US domestic companies, US large cap companies, small cap companies, mid cap companies, right? Wherever cap they're located in, I think the opportunity really is going to lie in making more investments back into US businesses. So if you think about it, tariffs can certainly be harmful from one aspect, right? Because money coming into the US now becomes more expensive, and companies will pass off some of this expense to the consumer. Not all of the expense will be absorbed, but some of it will be absorbed by the consumer. But on the same edge of the sword is that more money now is going to flow back into US businesses. And that actually is going to lead to additional growth of US companies. It should lead to more jobs within the US. It really forces more money to stay domestic than being sent overseas. And for the US economy, this is a very, very good thing. For the international economy, this has some more implications about, is this really a good thing? For international, probably not, but domestic, it definitely is. We won't feel the effects of this right away. Tariffs do take time. Once they're implemented, they take time to sort of trickle through the economy. I would say normally it's about 12 months or so out after tariffs are in place that we'll really start to feel the effects on a domestic level. But tariffs overall are really not a bad thing, especially if they're controlled well and controlled properly. So we'll see what happens when Donald Trump takes office and ultimately what policies he implements with his administration. But if tariffs are something that you're concerned about or just have some questions on, then I hope that today's conversation helps you out a little bit and just gave you some more insight on how they work. And again, our job is to make good investment decisions, smart investment decisions. So we can't control what the president is going to do, but we can control the decisions we make at the end of the day, and we can control where our investments are located, especially from an asset class standpoint. So with that in mind, I hope everyone learned something today, and I hope everyone has a very healthy, happy, and safe Thanksgiving holiday with their family, friends, and loved ones. And I look forward to seeing everyone in December as we wrap up the end of this year. So stay warm, stay safe. We'll talk to you soon.